next session, which is measuring up performance tests on the horizon. Certainly something that, we know there's plenty of conversations around and utilised broadly on the institutional scene and the institutional super funds. And is that likely to filter down into more the retail advice landscape? And to moderate this session, we've got none other than Toby Potter, a face familiar to many of us, and we welcome him back to the stage to moderate the session. Thank you.
Thanks very much, Matt, and it's my pleasure to introduce Julie Ballard, Channel Manager from Standard & Poor's, and Jason Petras, just getting a microphone on, who's a partner in Resonant. I am moderating one panel more than I had anticipated for a variety of reasons in this session. But what we are going to be talking about today are issues around, as Matt said, the potential for the sorts of regulator oversight and imposition to be applied in a managed account context, and the way, and some of the flow-on consequences that might have. So, Julie, let's start with your experience, S&P's experience, particularly, and start to bring a US context to this, in discussing how managed accounts, which are predominantly multi-asset managed accounts, might be benchmarked or are benchmarked.
Let's start with Australia. I know I've spoken at IMAP events previously, there's a few new faces who may not have heard this before, but just to recap. So in Australia, there is not really a standardized approach to the benchmarking of multi-asset portfolios. As many of you know, there's usage of RBA, or cash rates, CPI plus benchmarks. There is peer category averages. And there may be a small amount of usage of, for multi-asset composite benchmarks made up of market-linked benchmarks, which is very different from the way institutional managers benchmark. So the instos use composite benchmark linked to market. And if you look at, it's a bit controversial. We're not here to discuss your future, your super benchmark methodology. I know there's a lot of discussion around that. Is that appropriate? But those are using market-linked benchmarks in the underlying, for each asset class. So it is different. Why is it different? And we should look at, question, why do we do things as the assets in managed accounts increase? You've mentioned, I didn't see the latest number, $34 billion. That's growing quite significantly, but still quite small relative to the United States, where, based on Cerulli, it's $11 trillion. Unfortunately, we're 2 weeks before the 2024 Cerulli Managed Account report is coming out, so the data is slightly dated. But let's look at even just looking at their previous report, how do managed accounts benchmark? They actually use market-linked benchmarks. And I was speaking to my colleagues, James, who's from our team here, would know. I said, last time I did a IMAP presentation, I was asking them how things worked in the United States. I was talking about SMAs and how we benchmark here. Then I realized SMAs are very different in the United States as well. Here, we have multi-asset portfolios within SMAs. SMAs there tend to refer to single assets or single asset classes. So those are using market-linked. And their UMAs, which are the multi-asset portfolios, are using custom, or what I call composite market-linked benchmarks. And if anyone would like to check into detail, because I did, rather than just taking my colleague's word for it, I went on the website and I tried to get fact sheets on the various managed accounts. It's really hard. A lot of them are behind firewalls. But if you're interested, look at the Morgan Stanley US website, there is a list, you can click on it, and they list a primary benchmark, which is a custom or a composite, and there may be a secondary or risk-free benchmark, which is the ones I pulled tended to be 90-day Treasury bills.
Great, thanks, Julie. Now, Jason, Resonant's probably not so well known to the broader audience. So talk a little about Resonant and the portfolio construction process and how these sorts of issues feed into your thinking about building portfolios.
Sure. Thanks, Toby. I guess the approach that we've got is we're playing a role, obviously. There's a number of different counterparties and groups that are within an SMA solution. So you've got platforms, you've got the managers, you've got the advisor, and then you've got the underlying investment pieces as well. So there's a whole lot of moving parts in there, and there's also different responsibilities that you're dealing with along that chain of I guess command or delivery of returns. So when it comes back to those I guess issues around measuring performance and the testing on it, we're really looking at where those objectives are being placed that the RE is having to represent. So that's one of the first things. Making sure that the product is fit for purpose and is going to actually deliver on that. So we really approach that initial objective piece to say, on the overall design, is it actually going to be achieving its stated objective? Then you're moving down to the next level, which is really, I guess, more from an investment manager point of view, which comes back to the issue around, are you actually doing a good job within that objective space that you've been assigned? So it's sort of, I guess, there's a combination there of the long-term objectives. We talked pre the session, Toby, about sort of CPI type of stuff, and then also what you're doing within your space. So we ultimately look at it as a collection of parts. We're very, I guess, what you call product or implementation style agnostic asset consultant, in that we don't mind using direct equities, we don't mind using passive, we don't mind using active funds. We'll put it all together to build the best product, and we think that is the best way to achieve your objectives, but also give you the best chance to actually outperform in your peer groups.
So just thinking, the word objectives come up a few times, and so when an advisor sits down with a client, they're essentially trying to predict the future. I mean, what do we know? We know what are my expressed goals and objectives, what are my circumstances, how much money have I got, but then we're trying to find a portfolio that is most likely to meet those goals. So how do you work with advisors, or when you work with advisors, what is the way of trying to help them both draw out and explain how they'll meet objectives?
That is a conversation that I guess occurs not just between us and the advisor, but also ultimately the product issuer. So I'll use IMAP obviously as an example. That you're having to go back to the RE and say, this is what we're going to put on the table, and is it going to be achieving the stated objective? So, I guess, naturally most people, they want as much return as they can get for the risk they're trying to take on. So, but you've got to make sure that that's a realistic representation of what's achievable. So ultimately what we're doing is on our side, and I would assume that most asset consultants or all should be doing this, that you're effectively modelling up your portfolios, and then you're saying, we have a reasonable level of long-term data that shows that this is going to achieve its stated objective over the long run. Now, that's not necessarily saying it's a back test. It's simply saying on your asset allocations over 20, 30, really as long as data periods you can get, and you've actually got to submit that to the RE, and the RE is going to go, okay, yeah, well, we're actually happy with that.
And so that process is taking some capital market assumptions, and we've heard that come up in an earlier session, and your assumptions about the way markets perform.
Yeah, so I mean, it's actually less about capital markets assumptions. That's forward-looking. It's more about actually what has occurred. So you may actually go back through, the last 20, 30 years to say, what have bonds done? What have equities done? Using a very high-level asset mix, using I guess understood and acknowledged either indices or a passive investment, and saying, we've looked at this and we think it's going to achieve the CPI plus or RBA, sort of cash rate plus type objective.
The title of the session is performance tests on the horizon. So if we think about, one of the reputed effects of performance tests in Your Future, Your Super has been pushing people towards a more index-based approach. So in doing that modelling, Jason, you talked about not having a stated preference for passives or active or whatever. So how do you allow for the effect of active in making those projections to an RE?
So, I guess that's where you're now moving from objective back into peer group, effectively. So, the job that we have is to try and operate within. I'll take a step back. We're sort of your objective. You're saying that without using any level of active management, we can still achieve that.
Yep.
Right. So that's sort of that's your step one. So before we are really trying to implement any of our smarts and our capabilities, the product is fit for purpose and it should over long term achieve. Then you're saying, well, are we better than the next guy? And how are we going to do that? So that's where the active piece comes into, and that's where you bring in DAA. That's where you come into what's the right product to put in the right, the right tool for the solution in the portfolio.
Now, Julie, I have to ask, given that S&P, as most of you will know, are the sponsors of the creators of the SPIVA report, about active management and S&P's view of active, which is not to undercut Jason at all.
Maybe a little.
I might need to just correct that line of questioning. It's not our view of active. We just collect the data that's out there and report on it. We do it in a standardized way. For those of you who do not know SPIVA, it comes out for the end of calendar year. So the US SPIVA came out. For Australia, it's coming out in time for our master class. So that's on the 25th of March. So it takes a bit of a lag time to collate everything. And in the US, we've been doing SPIVA for more than 20 years. And unfortunately, in the majority of periods, active managers do underperform the benchmark. I think it's about 65% over 1 year, based on the latest report. But what's important is the longer term figures. So over 10 years, 15 years, you're looking at 91, 94. I think it might have actually ticked up a little bit. Based on the last report, might be 94 to 98% over that period. And for international equities, it's even a higher level of underperformance. And I also think it's worth pointing out, having a benchmark return or an index return isn't average. It's not necessarily median. If you look at SPIVA, and you can work this out yourself, because, US we use CRIS data, but in Australia we use Morningstar data. Morningstar, if we were to use the Australian example, you have first, second, third, and fourth quartile. And we don't determine those quartiles, of course. And you just, if you were to put where the benchmark is, you're looking at getting upper second quartile performance across most periods. And if you do the same for US, you're actually getting first quartile returns if you were getting benchmark returns. So try that yourself. I actually looked at the large cap core and using the S&P 500. And you know what? I looked at the graph. We've had this graph for a long time, but you had a session on IMAP where you beamed in a fixed income manager, Toby. And he was talking, first time I've heard an active manager talk about how great the ETF ecosystem was, because that's how they were acquiring some of their assets through the primary ETF market. And he actually plotted his return, and I'm like, oh, that graph looks like ours, but what's their returns? And I realized it was sitting on top of the benchmark return. So you can get top quartile returns with index.
So let's come back to this, because Jason, the Resonant partners are smart guys, and you place willingness to include active management in recommending a portfolio to meet a certain set of objectives. So how do you A, how's it gone? But B, how do you think about selecting those managers and those places where active can add value?
Yeah, so I mean, we actually fully subscribe to the not in a paying subscription, but from a philosophical point of view, SPIVA in regard to.
It's free, by the way.
Oh, okay. Well, I don't really look at. I've read the paper, but I didn't know if it was cost anything. But yeah, we do believe that it's very hard to find active managers that outperform. Like it's a very tough job, which is why we keep an open architecture around what we use, because when it is difficult to find those parts of your return makeup that are quite challenging, then we do tend to lean back towards passive, be it an ETF or whatever it might be. So having that flexibility, we think is really important. And then we have DAA over the top, which we've proven to add value. But I mean, in terms of like outcome, like we're top quartile on performance over inception at 5
That's why I picked them, by the way, for this panel.
So the numbers that we use for that are actually the Morningstar based data sets. So and they are tough to beat, and then you see a lot of passive in those high end of the second quartile, and then into the top quartile is actually a reasonable number of sort of more pure passive type things in there. So, yeah.
Okay. What I want to do is, I mean, one of the weaknesses clearly of the performance tests for your future, your super, is one size fits all. And, I don't know how many people are in those default funds, but, I think it's 12 million or some number like that. They cannot have the same set of goals or objectives. So one size cannot fit all. So Jason, when you work with a licensee or a practice and you go, right, we're going to create a set of portfolios for you, how much variance across the sort of broadly similar client bases, how much similarity or difference is there? I mean, the session before this was about retirement portfolios. Now, there's some real differences in there. So how do we express objectives that are appropriate for the very different client bases in broadly similar segments?
Yeah, I mean, I think you'd be surprised. There's definitely different objective out there, and you do see that. You just look at the PDSs and you can see a whole range of, there's CPI, there's bank bill, and then plus, quite a different range of objectives. But it sort of comes back to naming convention as well. Like most clients are looking for somewhere between 3 and 5 models, right? So from conservative up to high growth, and maybe something that's a direct equity model. So at that top level, objective level, it doesn't change so much. It really comes back to investment philosophy of what they believe in, and then saying, do I want to go down the path of using a blend of, passive or ETF or active or direct? So, and then it comes to how you construct that. And then do I believe in some active asset allocation? So there's a lot of those sorts of questions that really, where it revolves back to, do I want alternatives in the portfolio? Do I believe that they're actually going to add value? Do I want potentially a bit of high yield out of my lower sort of risk profile type models? So they're sort of where the dial is turned, because ultimately you've still got to front up to your platform with the RE, and they've got to be comfortable that how that product's being presented is going to be fit for purpose. So you can't go too far off the rails in that respect.
Yep. Now, questions for any of our panellists, of course. So if there are questions, put your hand up and Jenny will bring the microphones around. So, Rob.
Hi, Rob De Silva, Foresight Analytics. I guess it's not so much a question as perhaps adding a little bit more to, Jill, your comments about the indices and SPIVA. So your statistics, I think, are about large cap managers. And in
No, not all of them. We do small caps as well.
Yeah, I know you do it, but you quoted 90% underperform.
Oh, yeah.
That's not true in small caps.
Yeah.
So I think the last SPIVA report, I've seen some, there's much more evidence that in small caps, there's active alpha available.
That's right. The last US report, 70% actually was the best result for small caps. 70% actually outperformed the index.
Yeah, so,
And that was
You've
1 year.
You've
1 year.
anticipated a question we were going to come to, Rob, because
Okay.
you're quite right.
there's also two more tweaks to the methodology, and I've only looked at the Australian one, I don't know about the US. It's not measuring how managers do against their own benchmark, it's measuring how managers do against the ASX 200, or whatever you've picked, for Australian large caps, right?
We look at the categories of Morningstar and we use the most appropriate benchmark. And
Yes.
actually, that's actually another topic. Is the benchmark that's chosen by the manager the most appropriate? I know I've had a discussion with our product manager where someone asked us about a specific benchmark, and the product manager looked at it and said, "Well, that may not have." Well, it may not have been the most appropriate.
That could be a whole other discussion,
yeah,
for sure,
different
but it's
story.
not measuring it against the benchmark that the manager says they're going to outperform, or that they want
Yep.
to be benchmarked against.
That's correct. And I guess it's, trying to categorize things, and we try to use the Morningstar categories where
Yeah,
possible.
I get the logistical
Yeah.
issues with that. The biggest one in my mind, though, is that a index, whichever it is, whether it's S&P or,
Somebody else.
Russell or whoever, is a made-up thing. You can't invest in it. It doesn't have transaction costs. It doesn't have market impact. It doesn't have cash flows to deal with. So it's not a live situation that you can do. To my mind, the best alternative passive style of benchmark would be some kind of large index ETF, passive product from Vanguard, State Street, whoever, because that's a real live portfolio that does actual accounting and market impact and all the other stuff.
Yes, you can do that as well, and that could be one way of measuring the market impact. We're not saying you shouldn't do that. That is still using a market-linked benchmark. And I think it's also worth knowing there's the institutional version where the fees are taken into consideration. But if you take into account fees, transactional costs, you'll likely find that active managers in the main may underperform. There was actually a point when you were talking I was going to make, and I lost track.
You can say whatever comes to mind. Thanks. Anyway.
So who here, who's involved with managed accounts, has a benchmark for their portfolios that is market linked as opposed to either CPI or RBA or peer group as a benchmark? Yeah. So market linked over here. Is that so? I'm not seeing a lot of hands go up. I mean, I want to come back to the point that Jason made, which is you're talking to an RE and indirectly to licensees or advisors about the not misleading and deceptive, the ability to talk to a client about why am I recommending this as being the most likely way of meeting the goals that I understand you have.
Actually, Toby, before we move on to that, hang on to the question. I do remember what I was going to say. So the term investable was mentioned, and I have to say the recommendation for which benchmarks should be used is not something S&P determines. We develop, we do the calculations based on what the client in the market is asking for. And I think a good source of material for what benchmarks is most appropriate is the CFA Institute. Many of the audience here are CFAs. And there is a paper. There are GIPS standards. I think it stands for Global Investment something standards.
Performance standard.
Performance standards, that's right. So the GIPS standards do specify what's an appropriate benchmark. And there is a paper, UK CFA put it together. They do believe that market-linked benchmarks are good benchmarks. And I guess you can debate as to whether it's investable or not. But then you look at the other benchmarks which are being used. Peer category benchmarks are commonly used here in Australia. They make the point that these are not investable. You might think, oh yes they are because fund managers are already investing in them. But what is the median manager? you don't know what that is and what that portfolio is. Not my comments, the CFA. Also, CPI benchmarking. They actually termed that as bad. So the peer group was poor. This is bad. And quote unquote, it's aspirational to beat the CPI. So,
Okay, I'm conscious of time and the somewhat dryness of this topic. So look, what would it look like if ASIC or APRA did turn around and say, hey, if you're going to run, an SMA here, and call it balanced, here's our standard benchmark. What would the implication of that, do you think, be?
Look, it's a tricky one. Exactly how they're going to implement and whether it's actually a performance test, the way they've done with, super and the industry funds. If there's penalties around it, sort of repercussion versus what they're putting as the rule set. But ultimately, as long as it's transparent, we're really open to it. And I obviously say that because we've got good numbers. So, but at the same time, there is, the numbers that were put up before from Milliman in terms of what is a balance fund is actually quite concerning in my view. You've got stuff in there, okay, the 93% one might have been like a typo, but the rest of them, you've got stuff in there that's maybe 80% that's calling itself a balance fund.
Can I tell you that of the people who responded to this survey, the people who can't count to 100 and go over,
right,
neatly offset the number of people who can't count to 100 and went
I was
under.
going to ask maybe they didn't see the balance bit, but yeah.
Yeah.
But I think as long as it's transparent, and we need to get what is an investable, transparent track record of performance. So we've got, I think even there's a whole lot of questions around how would you actually gather the data and where's it coming from. Self-submission is questionable. So what we would want to see is taking actual real SMA performance data with real money from likely shadow portfolios and using that as the the performance data.
Okay. No, just scratching. Okay. Look, any final questions for our panelists here about the impact of performance tests on a managed account? No. Well, look, Vaughan. Yeah.
I was going to ask just a quick one. If you were looking to run those performance tests, if you were looking to run those performance tests on an existing model that you have, how would you do that? I've looked for the process that basically the tests are run on, the current existing tests on super funds, and there's not enough detail to get specific about it and actually run that against your own portfolio. Do you have any tips or suggestions in that area?
Not really sure what you mean by not enough.
Oh, what is it? How do you basically assign growth assets, defensive assets, income and whatnot?
Yeah, in the APRA paper, there is actually a lot of clarity. It's probably more detailed than anything else around what is and isn't a growth and defensive asset. So this is right to the point that that I was trying to make, is that transparency of what goes into what bucket is actually really key, because it's actually quite easy to game the system if there's ambiguity around that. So Morningstar, for example, will say if it's equity or property, it's growth and everything else is defensive, right? Which is fine. They've set a set of rules and you can understand it. APRA goes even deeper and says, okay, if it's this type of hedge fund, if it's this type of underlying, if it's this type of a long-short fund, and at least it's laid out there, right? So the only thing in the APRA numbers I probably question is probably private credit, in that it's defensive right now. But if that fund, I don't know, is buying a whole lot of debt that turns out to be converted into a restaurant, what are you now? Are you a small cap manager? And does that get redefined? So there's a lot of sort of questions on the finer detail, but it's probably a smaller proportion of the portfolio. But I think there's enough there now that you could probably take most SMAs and actually come up with whether they've actually passed that performance test or not.
All right, look, please join with me in thanking our panelists.